This chart shows the performance of the Medallion Fund. Between 1988 and 2018, it generated a 66% annualized gross return. That metric is widely considered the most successful investment track record in financial history, performing at a scale far beyond the reach of traditional funds. The man behind this fund, Jim Simons, was not a traditional investor or an economist. He was a mathematician and a former codebreaker for the U.S. government. Simons' background in high-level mathematics, including his tenure at elite institutions like MIT, formed a radically different approach to processing market data. He observed that fundamental analysis relied on predicting human behavior and macroeconomic shifts, variables that proved difficult to isolate with the mathematical reproducibility he demanded in a laboratory setting. This realization led Simons to explicitly discard the search for a narrative why behind market movements. He focused instead on a system designed to quantify only what was occurring in the data. Traditional analysis attempts to predict the trajectory of individual stocks based on headlines, earnings reports, or market sentiment. In a quantitative framework, these price movements are treated as non-stationary random walks. To the naked eye, they look like noise, but when passed through a mathematical filter, a smooth, repeating signal can be extracted from the chaos. The Medallion approach treats the financial market as a complex digital signal processing environment. The goal is to process terabytes of data daily to detect high-frequency anomalies, microscopic patterns that repeat reliably over thousands of iterations. Because human intuition is prone to panic and bias, the system uses automated execution to ensure every trade follows a strict, data-driven logic. To understand how this edge is achieved, we can translate Simons' philosophy into a market-neutral architecture and stress-test it against empirical data from the Indian National Stock Exchange. A durable quantitative system must generate returns across all market environments, regardless of whether the broader index is in a bull run, a crash, or trading sideways. This requires building market-neutral setups, specifically through the use of statistical arbitrage and pairs trading. This strategy identifies two co-integrated assets, economically linked securities whose individual prices move randomly, but whose mathematical spread maintains a stable, long-run equilibrium. By mathematically subtracting one asset's price from the other, the algorithm isolates the spread, effectively canceling out the directional movement of the market. When the spread deviates significantly from its historical average, the algorithm shorts the overvalued asset and goes long on the undervalued one, betting strictly on a return to the mean. This structure provides insulation from broader macroeconomic volatility, as the profit is derived from the mathematical relationship between the assets, rather than the direction of the sector. We can test this theory on the Indian market by looking at a study that applied this strategy to two highly correlated banking stocks, HDFC Bank and ICICI Bank. The first step calculates a static hedge ratio over a 5-year window using an ordinary least squares regression. Practically, this ratio means that for every 1 unit of ICICI held long, the algorithm holds 0.322 units of HDFC on the opposite side. The system operates on strict z-score rules. It will trigger a long position when the spread hits -2 standard deviations, a short at +2, and exit the trade as soon as it reverts to the 1 standard deviation mark. In theoretical, frictionless conditions, this static model represents the emotionless execution of mean reversion. However, the actual back-tested performance of this HDFC-ICICI model reveals the difficulty of maintaining an edge. A Sharpe ratio of 0.18 and a total return of 7.6% over 5 years barely outperforms a standard savings account, making the strategy unviable for institutional use. Part of this failure is due to execution friction. A realistic 0.10% transaction cost per trade aggressively erodes the thin margins of a high-frequency strategy. More dangerous is the vulnerability to structural market breaks, which led to a catastrophic drawdown of over 32%. In 2023, the merger between HDFC and HDFC Bank fundamentally altered the relationship between these equities. The static hedge ratio derived from the previous 5 years became obsolete, turning a once stable mathematical relationship into a source of loss. A static mathematical model will eventually fail as underlying real-world conditions shift. The map is not the territory. To maintain a superior return, Elite funds utilize relentless feedback loops and adaptive systems that account for these structural shifts. Research from SDM-IMD demonstrates how to upgrade this architecture by integrating hybrid machine learning layers. This chart shows the complexity of the media sector. Instead of manually selecting stocks, the upgraded model uses k-means clustering to scan the entire market for hidden, co-integrated pairs that human analysts might miss. The second upgrade replaces the static regression model with an adaptive Kalman filter. This filter recalculates the hedge ratio every single day as new price data arrives. This prevents catastrophic losses during events like corporate mergers by allowing the math to evolve in real time. This dynamic approach discovered highly profitable cross-sector pairings, such as Shree Cement and UPL, relationships that a human analyst would likely never pair together. Shifting to adaptive machine learning layers allowed this system to achieve a Sharpe ratio near 3.0, demonstrating that true alpha requires a model that moves at the speed of the market. This is the modern quantitative reality. Market inefficiencies are rarely found in headlines. They are hidden in complex, multidimensional code across time and risk factors. A sustainable edge begins by prioritizing statistical data over the desire for a narrative explanation. Achieving this level of performance requires architecting strictly market-neutral setups that isolate stationary signals while accounting for every cent of execution friction. Finally, the architecture must incorporate adaptive machine learning to ensure the model evolves as real-world market structures shift. Jim Simons achieved his 66% return by engineering a machine capable of measuring mathematical realities of the present more accurately than traditional funds.